Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Our first guest on the show today is Scott O'Neil. Scott is the director at Rethink Investing. Hello, Scott, and welcome to the show.
Hello, thank you for having me.
You are very welcome. Now, as we know, the market's starting to cool a little bit out there. So probably a topical question right now is, what is the best way for investors to create equity?
Yeah, definitely. So in the last few years, what worked back then doesn't work anymore. So you've got to be a little bit more creative to get the same result. So I thought today I'd just go through our three most popular and profitable techniques our current clients are using in 2018. So the first one is duplexes. So when everything's sort of slowing up growth-wise, you need to create equity. So I'm going to just run through some rough numbers. This is based on a Brisbane property, middle ring suburb. We can build them for $520. That includes the land. The cash needed for the deposit stamp duty is going to be about $120. And when they're completed, they're worth $620. So that's an equity uplift of about $100,000.
And quickly as well, it sounds like.
Yeah, well, it's a 16-week build time, but then you settle on the land. So just call it 6 months. So, it's quite quick, minus about 20 grand in costs, like your holding interest costs and your agent fees, stuff like that. You're left with, an 80 grand profit. So you've turned that original 120 into 200,000. So that's a nearly 66% return on cash invested. So a lot of people don't break down the numbers when they invest, and it's hard to make decisions if you don't. So 66% like on little risk taken, and in a quick time, it's very popular.
I can imagine why that's popular. Is that available to everybody? That's something. There's no barriers to entry, is there? I mean, anybody can get into that.
Yeah, it's just hard to find these sites. So 100% of our stuff we buy is offline. So you don't see it on realestate.com or Domain. It's offline, and it's going to be cheap land, and we don't get ripped off by the builder. So there's no hidden developer fees to the buyer's agent, which many of them get charged that. We don't accept fees at any point, so that means you can undercut the market considerably. And then all you've got to do is strata title the duplex, which costs $6 grand with surveying and council fees, and then you've got two properties, which you can revalue and sell or just refinance against.
And it's probably worth mentioning now, isn't it, that these figures that we're talking about now, these examples, these are actuals from your business that your clients used and benefited by in your 2018 year.
Yep. As of October this year, 2018, that's current price.
So this is all relevant information.
Yes.
Yeah. Cool.
And the other real popular technique as well is just barrier to entry cheap properties. So we've always liked targeting distressed sales. Middle ring suburbs, again, not riddled with housing commission, not too old, but they're going to have land components. So over the years, we've bought, over 1,000 properties, and that's built very good relationships with agents. So the agents send us properties when they need a quick sale. And, you can get into a good property with as little as 40 grand. So that's, 10% deposit plus costs on a $200,000 property. Go 250, you're still looking at a very low property entry price, and you can make very good capital growth out of those because you're buying under market value, and then you're buying in a depressed market, which means there's capital growth upside as well. So pair of those together, it's a great start for investors, and anyone that thinks you can't get into a capital city for very little money, they're just not looking hard enough. And this is one way of doing it.
And again, I'm going to come back to this. These are actual examples. This is experience that you have with your clients. I think the thing is, on paper it always works well to buy low, and then as you say, you get that double whammy effect as well. But the thing that makes it work here is that you've got that network with agents, because not everybody has that network, and it's about knowing where those distressed properties are and getting them at the right time. So it's that network that you have, that's all the difference, isn't it?
It is, and that's what's really changed. Even like when I started Rethink Investing, it took a couple years to really have enough contacts to continually produce results like this. When you go out on a loan, you're just not going to be able to do it. You might network with one or two agents in your local area and get a good deal, but if you're not buying every day of the week, day in, day out, year after year, agents won't think of you. They'll think of another buyer's agent or professional buyer, and you lose the good deals to them. So in a lot of times, the leftover stuff comes on realestate.com because all the quick sales have been cleaned out by people like myself.
And this is not just in your local area. This is across the country. Am I right in saying that?
Yeah. So you've got to move around to different markets. So we're not buying in Sydney. We stopped buying here in 2015. We've been quite busy in Tasmania. We were buying down there in 2014, got great results there. We're now really heavily sort of investing up in Brisbane, but in areas that aren't oversupplied, they've got all the fundamentals that are stacking up, and I think that'll have the best 5 years coming up.
Coming forward now. Yeah. Cool. So that's 2 out of 3. What's the third one?
So the third one's the commercial stuff. So I've seen a lot of people diversifying because I've got a lot of clients from Sydney and Melbourne. They've done quite well and they've got very poor cash flow, equity rich though. So rough numbers, like our average commercial property is around 400 grand, 8% net returns are what we're hitting currently, and that's 32,000, but the tenant pays all your outgoings. So your rates, your water, your insurance, it's all covered. So on a 70% debt, 5% interest rate, you're looking with an 18 grand passive income after all costs. So you could imagine that's quite popular because you're not spending a huge amount, your debt's not massive, and 18 grand passive income. Buy 3 of them, you're halfway there.
Those are good numbers. Now, when you talk about commercial property, and a lot of people that I talk to say, first thing, lots of extra risk, lots of things that they don't understand about it. Are those valid concerns?
They are if you go in green, but like I mentioned in our last podcast, we buy things that are easy to fill. So small warehouses under 300 square metres next to expanding populations. That means there's going to be a lot of trades that need these spots. You can quantify it quite easily, the vacancy, by checking what all the other similar properties have been first listed to first filled date. Average it all out, you might have 3 months vacancy. That's acceptable when you're getting returns like this. Medical's the other side of things, like, real expensive fit outs, long leases. We're not buying regional shop fronts or 4,000 square metre warehouses, because if they go vacant, that's where, those myths come from with the property. Because they're not myths, but if you buy that type of stuff, you're going to, have trouble finding new tenants. So we avoid that.
And I think that's the issue, isn't it? Is understanding what the risks are and then what you need to do in order to mitigate them, and then also just working with an expert, somebody that can help you and take the stress out of it.
Yeah, and look, we there's 10 times the work involved, won't lie. We've got to understand the age of the business owner, the tenant. We've got to understand the industry direction. Like, we like storage because it's a growth industry, more online, like Amazon style stuff. People need to store. Things that are declining, long-term office space. More people are working from home 1 day a week extra. There's less need for an office. So long-term, I wouldn't invest in that unless it's sort of like a nice ground floor, well-located type place. Then that's different. But the property's got to be unique. And if it's unique, you're going to have tenants that need that space.
Scott, as always, lots of food for thought. Lovely to have you on the show. Now, if anybody wants to learn more about what we've talked about today or anything about Rethink Investing, how do they find you?
Best way, just call 1300 965 551 or email info@rethinkinvesting.com.au.
Thank you, Scott. Our second guest today is Simon Presley, a regular guest on the show now, Simon, and head of research at Propertyology. How are you, Simon, and welcome to the show.
Yeah, thanks for having us back, Tim. Hope we're all well.
All good. So it's a start, quite a quick start actually to the year, and things are pretty much going smoothly from the get-go. There's some implications on that for property investors, isn't there, Simon? And we were talking a little bit around the so-called cooling markets, and maybe just getting a little bit more understanding of about exactly what that means and the implications of that to property investors.
Yeah, look, it is. 2019 is going to be an interesting year, but I'd encourage anyone who can afford to invest in 2019 to do their best to block out the noise. Been a lot of negative commentary over the last 12 months, and much of that is related to a downturn that's underway in Sydney and Melbourne. That was always going to happen. They had to both those markets had a strong growth cycle, but large parts of Australia, their growth cycle is yet to unfold, and we think that we saw signs of that commencing in 2018.
That's the issue, isn't it? Is that those two markets are probably primary movers in the Australian sort of landscape, but they're not the only two markets, are they? And the other markets sort of feed off the impact of those two.
Look, to a degree. I mean, a lot of Australians probably aren't aware that throughout our 8 states and territories, there are 180 individual towns and cities that have a population of 10,000 people or more. That's a heck of a lot of property markets, 180. But because Sydney and Melbourne are our 2 biggest cities, whatever's happening in those 2 individual markets is broadly what gets reported. If we go back a few years ago, it was broadly reported that Australia was having a property boom. It never was. Our 2 big cities were having a property boom. And now those same 2 cities are having a downturn, and it's broadly being reported that the nation's having a downturn. But for large parts of Australia, I must really stress this, it's some really, really exciting times ahead. There's some really strong economies out there. There's some markets with vacancy rates that are well below 2%. Housing supply is very tight. Yields are strong. Job growth has been spectacular. And we're actually anticipating a boom era ahead. So keep focused on fundamentals, not the noise.
That sounds like it's a really a strong position to be in for investors that are looking to get active this year or to accelerate this year. Some of the things that are sort of coming up in the news and coming across the radar screen is obviously the Banking Royal Commission, or the report on that's coming up soon, and also the federal election. How do you think that investors should be preparing for those things now as they look to take advantage of the boom ahead, Simon?
Yeah, I mean, the first is be aware that it's going to be reported about. There's a lot more to Australia than property markets, whilst we're all property junkies. So it's going to be reported about. But a Royal Commission or a federal election, these things happen every so often. Federal elections come around every 3 years. So, but you look back over Australian history and you don't get booms or busts based around federal elections. Royal Commissions, we've had tax inquiries and all sorts of inquiries before. I actually think the pain that this is going to cause property markets is largely behind us. Still a lot more reporting that needs to unfold, but I think credit's already a lot tighter than what it needs to be, and I anticipate that at some stage soon you'll see some relaxation in credit. The national economy requires that to happen. Negative gearing, it's still very much up for debate whether that will be scrapped at all. This may surprise listeners, but Propertyology doesn't think that if negative gearing was scrapped, that it will have much effect at all. There are a lot more important things that have an influence on a property market than an individual tax policy. At the end of the day, stamp duty is a tax policy as well, and they change stamp duty policies in different states all the time, and it doesn't cause markets to boom or bust. So negative gearing only affects investors. People need to be mindful of, and that's only 30% of the buying public. And of that 30%, half investors have a property that's cash flow neutral or cash flow positive. So the biggest influence on property markets is not tax policies. It's localised economies, it's local confidence, it's local affordability, and it's local housing supply. They have a much bigger impact, and the fundamentals there are quite strong, as I said, in most of Australia.
Sounds good again, and more positive sentiment coming out. I do like the way that you're positioning it around the negative gearing, because that is starting to get a little bit of traction, and people are starting to become a little bit caught in the headlights with that. So it's nice to hear that you're saying it's not.
Yeah, I think it's the fear of the unknown, Tim. I think that, it's never happened before. Negative gearing has been around for 100-odd years. So lots of speculation, including from economists who claim to have created a model that works out what this will do if it was changed. I am exceptionally confident that that's a big if negative gearing was scrapped, it'll just become the new norm. But put it into context, it only affects a small portion of property buyers. People don't seek to invest to buy a piece of negative gearing. They seek to invest because largely they don't want to be reliant on an age pension in years to come. So that won't change. Not many people seek to put their hand out for that age pension. Take control of your own future and invest.
It's a good reminder as well, isn't it? Is that's not part of the fundamentals of why you would get into an investment property. There are other things, there are other drivers. And as you were saying, was it 180 markets around the country? Plenty of low-hanging fruit in those markets, I would imagine.
Absolutely.
Terrific, Simon. Thanks again for your time and your insights as always. Now, if anybody wants to learn more about what we've talked about today or Propertyology, how can they get hold of you?
Our website, propertyology.com.au. There's some wonderful blogs on our insights page at the top of the menu option, or give us a call on 1300 65 4070.
Mate, always a pleasure. Thanks very much for your time.
Good on you, Tim.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.